Hey everybody, welcome to the whiteboard. In this segment we're going to be discussing the margin debt levels at the NYSE and how you can monitor these levels to help you get an idea of how confident traders are in the marketplace. Now, the margin debt level is a measure that tells us how much stock traders have bought on margin. And when a trader buys a stock on margin, what he's doing is he's borrowing half of the money from his broker to buy a particular stock. And so what he's doing is increasing his leverage from being 1-to-1 to 2-to-1. So let's say you've got a stock here that is worth $20. Well, what the trader will do is he'll put in $10 of his own money, and then he'll go out and he'll borrow the other $10 from his broker. And he does this so that if the stock price goes up, he gets even more bang for his buck than if he had put $20 of his own money into the trade. Because let's say the stock goes from $20 all the way up here to $30. Well, the trader has now made a $10 profit. So if it went up here and he made a $10 profit right here, he made $10 off of only $10 of his own money. So that's 100% profit. Whereas if he had put his entire, he had used his money for the entire purchase price, he would have only made 50% on his money. And naturally, we would all like to earn 100% on our money instead of 50% on our money. It just works better. It also works against us if stock prices go down. Leverage is a two-edged sword, and it can hurt us just as much as it can help us. But this is what traders are looking to do. They're looking to use some of their broker's money to increase their leverage so that when stock prices go up, they get a better bang for their buck, and they can also go out and buy twice as much stock. If they only have to put up half of the capital, they can go out and buy twice as much stock. Now, what the NYSE does is it goes out and it monitors just how much money all these traders have borrowed to purchase stocks on the New York Stock Exchange. And once a month it releases these numbers and tells us how much traders are investing. Now, if traders are buying more and more stock on margin, that's a sign that they are becoming increasingly confident in the stock market. They think stock prices are going to go up, and so they are increasingly willing to borrow money to buy those stocks in the hopes that they will return a nice profit for them. On the other hand, if we see the margin debt levels going down, we know that traders aren't as confident in the marketplace. They're pulling back a little bit. They're not taking on as much risk because using margin is a risky proposition. It can hurt you if it goes against you. And so they are pulling back on their risk as the stock market is going down, and it's showing that their confidence levels in the stock market are decreasing. And so if you watch the ebb and flow of this margin debt level, you can get a pretty good idea of how confident traders are or are not in the stock market. And we saw recently that in July of 2007, we hit a nice peak on this NYSE margin debt level, and that was at the height of the markets, really. And then it started to taper off as more and more risk started coming into the markets thanks to the subprime meltdown, the credit crunch, everything that we've been facing. Recently we saw a really steep decline in the NYSE margin debt levels, and what we're waiting for now is to see when those levels are going to rebound. And so you want to watch these levels and see when are we going to find that bottom and start moving back up. As soon as we can find that bottom and start moving back higher, that shows you that the big institutional traders on Wall Street are gaining confidence in the stock market. They're gaining enough confidence to put their neck out on the line by borrowing money to buy that stock. And it shows that it may be a good time for you to start buying stock as well. You don't have to buy stock on margin just because the bigwigs on Wall Street are, but it shows you that they're confident enough in the market to be borrowing money, and it shows you that it may be time to start getting back into stocks because they may be swinging back upward. So that's the New York Stock Exchange margin debt level concept in a nutshell. Thanks for joining me, and we'll see you here next time at the whiteboard.